Welcome back, financial architects and data maestros. In our last session, we laid the unshakable foundation, delving into the market data, building crucial supporting schedules, and meticulously crafting our assumptions, the very brain of our model. If you missed the part 1, pause right now and go watch it, because today we are moving from blueprint to building out. And a quick reminder, for those of you who want to dive deeper to hold this entire polished financial model into your hands, simply drop your email ID in the comments below, along with a piece of feedback on what you truly liked about this specific video or the Bankers Bootcamp YouTube channel in general. Your insights are valuable and the model is yours. Today we ignite the core engine of our financial model. We are building the income statement, the balance sheet, and the cash flow statement. But we are not just building them, we are revealing the intricate web of connections that makes a truly robust model sing. Get ready to witness the symphony of statements. First up, the income statement, the performance report, the story of profitability. Based on the meticulous assumptions we crafted in video 1, this is where we project our revenue, costs, and ultimately our net profit over time. This isn't just about listing numbers, it's about translating our strategic outlook into a financial performance. So guys, if you remember in the first part, we are done with capturing the market data, capturing all the assumptions that are required to build this model, capturing the asset schedule which eventually will flow into the assumptions, and the calculation of beta. Now we move forward and see how the income statement is populated from the assumptions that we had captured. So this income statement follows the standard template that we have on the regular P&L statement. It shows you revenue, then all the costs, breakdown that is required to capture the cost of goods sold. Then we capture EBITDA by the revenue minus total cost. Then we reduce the depreciation from it to capture the operating profit, which is EBIT. Then we capture the interest expense and net of other income, if any. In our Ashok Leyland case, we do have the net of other income and the exceptional items. Finally, we capture EBT or PBT, the profit before tax, by reducing the interest expense from EBIT and adding the net of other income and exceptional items. Then we capture the taxes, the tax expense, and subtract it from the EBT to get the PAT. We capture the minority shareholding and then we finally add it to the PAT of parent shareholder. We capture the dividend payout percentage and capture the retained PAT eventually. So now if you see where exactly the values for this income statement are coming from, revenue comes from the assumption sheet. So remember we had captured the revenue in the assumptions. Then all the cost breakdown is again from the assumptions. Total cost is a summation of these numbers. Then we have calculation of EBITDA. As I said, EBITDA is revenue minus cost. Then we have EBIT, which is EBITDA minus depreciation and amortization, of course, if there was any. Then we have the interest expense, net of other income, and exceptional items. So we calculate EBT by taking EBIT minus interest expense plus net of other income minus any exceptional items that we have. Then we capture the taxes and we calculate the PAT, EBT minus taxes. Finally, we capture the minority shareholding and the PAT of the parent shareholding, which is PAT minus the minority shareholding. We capture the dividend payout and the retained PAT accordingly. The dividend payout, which is captured over here, is based out of assumptions, and the retained PAT is simply 1 minus percentage of the dividend payout, basically whatever was the retention ratio, into the PAT of parent shareholding. So here on the screen you see the whole populated income statement. As you can see here on our income statement sheet, every line item from revenue down to net profit after tax flows dynamically from our assumption sheet. Our growth revenue rates, our COGS as percentage of revenue, our operating expenses, they all spring to life here, painting a clear picture of Ashok Leyland's projected earnings potential. Notice the clarity. Each category, revenue, cost of sales, gross profit, operating expenses, EBIT, interest, PBT, tax, and finally PAT is clearly defined. The structure isn't just for neatness, it's for analytical power. It allows us to pinpoint drivers of profitability and identify key trends. Every cell here is a direct calculated consequence of the assumptions we laid down. Next, we move to the balance sheet, the snapshot, the ultimate proof of financial health. This statement at any given point of time must always balance. That is, assets must equal liabilities plus equity. It's the immutable law of accounting, and it's our ultimate check for model integrity. Now let's move on to the balance sheet. I have prepared a very clean balance sheet which talks about the assets and below the liabilities and equities, and below the liabilities and equities. So on the asset side, you will see cash and cash equivalents, which is again taken from the cash flow ending balance. So this initially would remain blank, and once you populate your cash flow statement, then the ending balance of cash flow in the cash flow statement will flow over here. The current work in progress is taken from the assumptions, investments, inventories, trade receivables, loans and advances. All of them are taken from the assumptions. Then we have other asset items, which is also taken from the assumptions sheet. Now we land down onto our capex. Again, all the capex is basically captured in the assumption sheet. Then we have accumulated depreciation, which is again coming from the assumptions. Why assumptions? Remember, because we have created the asset schedule and the depreciation we have captured back into our assumption sheet. Then calculate the net fixed assets, which is the total of the capex minus the accumulated depreciation. And finally calculate the total assets, which is the summation of all the above things. So if you see, there is a breakdown of short-term or the current assets and the long-term assets. If you look on the liabilities side, you will see long-term borrowings, which is nothing but the non-current borrowings, again from the assumption sheet, because remember, we haven't captured the debt schedule, but if you had, these values would have come from the debt schedule. The short-term borrowings, which is the current liabilities, the lease liabilities, other borrowings and other liabilities, everything we are taking from our assumptions sheet. We add up the total liabilities, which is the summation of all the short-term and the long-term liabilities, and in equities you will see a very clear-cut segregation of just the equity capital and the reserves and the surplus. So reserves and surplus will eventually contain the PAT that I have finally computed in the assumption sheet taken from the income statement. We had done a check there as well, and I'll show you how exactly that matches over here. Then we have the summation of total equities. So for reserves, let me take you to the assumption sheet. So if you see the reserves for 2020, this is basically coming from the market data. But if you notice for 2025, where we have projected the number, this will tell you that it is the summation of the previous year reserve plus something from the income statement. Now what this something is, the retained PAT that you see in H column. So hence your reserves in the balance sheet is the summation of all the retained earnings that the company has from its inception. Now we add up the total liabilities and equities, which is the sum of total liabilities over here and total equities over here. So here you see the whole balance sheet populated for the assets and the liabilities and equities. On our balance sheet, you will see how we construct this critical statement. Our asset section, for example, directly incorporates figures like property, plant and equipment, which is dynamically linked from our asset schedule built in video 1. Taking into account new capex and depreciation, our current assets like inventory and receivables are driven by the assumptions we made for inventory days and receivable days. Similarly, on the liability side, our debt figures flow from financing assumptions or a detailed debt schedule if we had built one. And our equity section, the cornerstone of ownership, is where we will see one of our first critical interconnections, which we will explore shortly. Every item here is either directly linked to our assumptions, driven by supporting schedule, or will be reconciled through our cash flow statement. It's a continuous loop of financial logic. Now, for cash flow statement, the king of all statements. While the income statement tells you about the profit and the balance sheet about the worth, the cash flow statement tells you about liquidity, how cash is generated and used. It reconciles the accrual-based income statement with the balance sheet, providing the clearest picture of a company's true cash-generating ability. Now we'll move on to the next and final statement of ours, which is cash flow statement. So cash flow statement, as we know that this is the indirect method that we are capturing the CFO, where we start with the PBT. This PBT is taken from the income statement, and if you see, the value is EBT value in the income statement. Then we add back the non-cash charges or non-cash expenses, which is basically in our case depreciation and amortization. We add back the deferred tax liabilities, we add back any interest expenses, we subtract the other income, we add the exceptional items, and we capture the changes in the working capital. So cash flow statement has a specific functionality which says that if the cash is coming into the accounts, it should be treated as a positive number, while if the cash is going out of the accounts, it is treated as a negative number. Hence, increase in the liabilities basically increase the cash amounts in your cash accounts. All the changes in the liabilities are added up over here, while all the changes in the asset side have been subtracted over here. So that captures our total CFO. The CFO is basically nothing but the PBT plus non-cash charges plus deferred tax liability plus interest expenses minus other income plus exceptional items plus changes in the working capital. Then we move on to CFI, which is cash flow from investing. Now indirect and indirect method, this remains same. So we have purchase of fixed assets, which is a negative number taken from the assumptions. Then we have proceed from sale of fixed assets, again taken from assumptions. The purchase of investments, sale and redemption of investments, intercorporate deposits given, intercorporate is received, acquisition of subsidiaries or the business is interest received, dividend received, other investing items received, other investing items paid. So sum of all the above is going to give you the CFI. Ensure that you follow the same methodology. All cash going out is taken as negative, all cash coming in is taken as a positive. Now we move on to the final phase where we are computing the cash flow from financing activities. So this starts from the proceeds from shares, then if there is any redemption on the debentures, any proceeds or the sale from the borrowings, any repayment of borrowings, interest paid, dividends paid, financial liabilities, other financing items received and paid both. Now again, taking the same functionality into account where cash coming in is positive and cash going out is negative, we compute the cash flow from financing activities. The summation of CFO, CFI and CFF are going to give you the net cash flow. Now to calculate the closing balance, we take the opening balance for that particular year, add the net cash flow to it and calculate or capture the closing balance. So in short, closing balance will be equal to opening balance for that year plus net cash flow for that year. Now if you see, here we have in front of the screen all the populated numbers for our cash flow statement, whether it is CFO, CFI or CFF. Capture the net cash flow and calculated the closing balances. On our cash flow statement sheet, we built it out in three fundamental sections. Cash flow from operations, CFO. This starts with our profit before tax from the income statement and then adjusts for non-cash items like depreciation and changes in working capital, like increases in receivables or increases in inventory or changes in payables. This is where you understand how much cash is generated from the core business. Cash flow from investing, CFI. This captures cash used for or generated from investments, primarily capital expenditures, capex, and any asset sales. Our asset schedule feeds directly into this. Cash flow from financing, CFF. This details cash flows related to debt, equity, and dividends. Essentially, how the company raises and repays capital. The sum of these three sections gives us the net increase or decrease in the cash for the period. And this brings us to the truly fascinating part, the interconnections that make the entire model a robust self-correcting system. Let's uncover the first critical link, how the income statement connects with the balance sheet, specifically through profit after tax, PAT, and retained earnings in the equity section of the balance sheet. This is a fundamental flow that many overlook. Our income statement culminates in net profit after tax or PAT. This is the profit available to all the shareholders. What happens to this profit? A portion might be paid out as dividends and the remainder is carried forward and accumulated in the retained earnings section of the equity on the balance sheet. So the formula is elegant. Beginning retained earnings plus PAT minus dividends is equal to ending retained earnings. This continuous flows ensures that the earnings generated each year are accounted for the balance sheet, directly impacting the company's equity value. It's the lifeblood of equity growth within your model, seamlessly transferring value from the period's performance to the cumulative worth of the company. Next, let's trace the crucial link between the income statement and the cash flow statement, the connection via profit before tax, PBT. While the income statement reports profit on an accrual basis, meaning revenues and expenses are recognized when earned or incurred, regardless of when cash changes hands. The cash flow statement aims to convert that profit into actual cash. This conversion often starts with profit before tax or PBT from your income statement, which you will see right at the top of your cash flow from operations section, CFO. From this PBT, we then make crucial adjustments for the non-cash items like depreciation, which reduces profit but isn't a cash outflow, and changes in the working capital accounts like inventories, receivables, payables. This PBT acts as an initial bridge guiding us from the accounting profit to true operational cash generated. It's the starting gun for our cash reconciliation journey. This is the grand finale of our statement interconnections and arguably the most vital reconciliation. How the balance sheet and the cash flow statement are connected via the cash and cash equivalents balance. Your cash flow statement calculates the net increase or the net cash flow in the cash for the period, calculates the net increase or decrease in the cash for the period, net cash flow, and then adds that to the beginning cash balance to arrive at the ending cash balance for that year. This ending cash balance is not just a number, it's the exact same number that appears as cash and cash equivalents under the current assets of your balance sheet for that corresponding year. This is the ultimate check, the fundamental proof of a fully integrated model. If your closing cash on the cash flow statement doesn't perfectly match the cash on your balance sheet, your model is broken. This seamless flow proves that every transaction, every assumption, and every calculation has been accounted for across all the three statements. It's the financial equivalent of a perfect circuit. Now, building these statements is one thing, but ensuring their accuracy and robustness is another. This is where the audit checkpoints come in, your guardian angels for model integrity. These are small but incredibly powerful formulas embedded throughout your model, designed to immediately flag any inconsistencies or errors. Think of them as internal alarms. There is a check over there. This check is basically with the CFO, where we are first computing what is the EBT minus the EBT that we have captured at the CFO. See, it's all zero because this EBT only goes as a first step in the cash flow state, and that's why this audit point is checked. Also, if you note, the next audited point is where we are checking whether the total assets are equal to the total liabilities plus total equities, and you see our check is true everywhere. Also, these closing balances will go into the cash and cash equivalents on the balance sheet. So here you see the audit point check where we are checking both of those things, and everything is matching. So you see the audit point is true, and hence it shows that whatever the cash and cash equivalents that we have captured on the asset side are taken from the cash flow statement. The most crucial one, which we have built into our balance sheet, is the assets is equal to liability plus equity check. If this formula doesn't equal 0 or a tiny number due to rounding, you know immediately that something is wrong and your balance sheet isn't balancing. We also have checks on our cash flow statement to ensure the beginning and ending cash balances tie out precisely. These checkpoints aren't optional. They are mandatory for professional modeling. They save you countless hours of debugging and give you unwavering confidence in your model's output. A model without clear, visible audit checks is a liability, not an asset. Let's hammer this home because it's the golden rule of financial modeling. The balance sheet must always match. Assets must equal liabilities plus equity. This isn't just accounting principle, it's the ultimate internal consistency check for your entire integrated model. If the model is built correctly, then all the interconnections we have just discussed, PAT flowing to retained earnings, cash flow tying out to balance sheet, then this equality will naturally hold true. If it doesn't, it means there is a disconnect somewhere, a broken link in your chain. Your model's ability to balance is a direct reflection of its underlying accuracy and the logic you have implemented. Finally, let's talk about the presentation and usability. Look at our headers across the financial statements. We have ensured that they are very simple, yet detailed enough to capture all crucial information. Avoid jargon where plain language works. Ensure consistency in naming conventions, but don't shy away from providing enough granularity for a clear understanding. For example, instead of just using expenses, we break it down into operating expenses, depreciation, interest expense, etc. This allows for detailed analysis and makes your model easy to navigate and understand, not just for you, but for anyone who reviews your work. And there you have it. The core engine of our financial model is now fully assembled and seamlessly integrated. We have built the income statement, balance sheet, and cash flow statement. And more importantly, we have uncovered the intricate, unbreakable links that tie them all together. So that completes our engine room for the Ashok Leyland. And now we have captured all the three financial statements and done the audit checks on every other point and ensured that these three financial statements are connected to each other. You now understand how profits flow to equity, how PBT kickstarts your cash flow, and how ultimately the cash balances reconciles everything. In our final video, we are going to take this powerful model and unleash its true potential. We will dive into valuation, scenario analysis, and present our findings like a true financial guru. You absolutely cannot miss the part 3. If this video helped you to conquer the financial statements, hit that like button, subscribe to the Bankers Bootcamp, and ring that notification bell. And remember, for access to this complete model, drop your email and feedback in the comments below. Until next time, keep modeling with precision.